the number is stable. So maybe we should get started. Okay, so thank you everybody for joining us for the last of the regular sessions for the Microstructure Exchange for this season. Next month on July 7th, we're going to start with the Emerging Scholars Month. Very happy to have Marius Zoican here. Just one more housekeeping item before we start, or one and a half. The first one is that the submissions for the fall, the deadline is tonight. I think it is midnight Pacific time. And so we welcome to see submissions so that we can have a nice full running seminar series in the fall. And to those of you, if there's anybody has joined from Asia and Australia, we're currently looking into a solution so that you can see these seminars at a time which is, as somebody from Australia put it, more human. So we're working on that one. But for now, we are very happy to have Marius Zoican here. In case the rules are not clear to everybody, Marius will have, I think, 3 breaks where he stops for questions. I would recommend that you put the questions in the Q&A. If you see a question that you have already, that you like, that you want to get answered, please upvote it. And then I will ask that question to Marius during the regular talk. And then by the end, at around 11:45, we're going to open it up for general Q&A where you can raise your hands. And Marius has agreed to stay on for a little longer after noon, our time, so after the hour, to answer some additional questions. So okay, we're very happy to have Marius here to talk about the value of ETF liquidity. Marius, the floor is yours.
Thanks, Frank. Thank you very much, Andreas. Thanks for having me for this seminar series. So this is actually a paper that was joined with 2 Australian co-authors, Marta, Khomyn, and Tālis Putniņš from University of Technology, Sydney. And it's motivated by the growing importance of ETFs in financial markets. I'm going to zoom in particular on this ETFs tracking S&P 500 as a motivation, and I'm going to show you the model and some empirical evidence. So ETFs have been growing quite steadily as a fraction of the US trading volume, from less than 5% in the early 2000s to 30 to 40% a couple of years ago. But actually 50% of all this trading volume is concentrated in ETFs tracking the major indices, so stuff like the S&P 500 or the Russell 2000. There are many ETFs that are tracking some more niche areas like biotech or blockchain, but the bulk of the volume is still in major index ETFs. So a natural question is, how do they compete? Why do we have 3 or 4 products that are quintessentially identical? So what we're going to do to motivate this paper is I'm going to zoom on the best known index, the S&P 500. So there are 3 ETFs that track the S&P 500, which, bar perhaps different tracking error, but not so different. You can think of them as quasi-perfect substitutes. The Spider, which is offered by State Street, was the first one in this space. It started in '93. Then BlackRock launched IVV in 2000. Then Vanguard came as a third mover. So you think of these as identical products, but they actually charge very different fees. They have very different management expense ratios. And in particular, Spider, the first one in the space, charges almost double than the competitors, right? It charges 9 basis points as an MER, whereas IVV has a fee of 4 basis points and Vanguard's VO has 3 basis points. And if you think, okay, this is motivated by the fact that Spider has a lower tracking error, that's not the case. Actually, Spider will have the highest tracking error. So this is a bit puzzling. How can identical products have different prices? If you zoom in on the market characteristic, if you look at volumes, you actually see that Spider is the most traded one by far. Has a 25 billion daily trading volume compared to around 1 billion for its competitors. So not only that Spider is the expensive one, but it seems that traders actually actively go to trade the expensive ETF, right? They don't seem to put a lot of value on low fees, and that's a bit puzzling, and that's something we're trying to explain in this paper. One potential channel, and this is sort of where we're trying to go with this paper, is perhaps the traders, the clienteles of the ETFs are different. And here we took a picture from Morningstar Direct showing the relationship between flow funds in the free ETFs and the S&P monthly performance. So you can see that in iShares and Vanguard, the flows seem pretty flat with respect to the monthly performance. So this is something like a long-term trader would behave, regardless of how the market is doing. They're just putting more money in as they accumulate savings. But if you look at Spider, if you look at the expensive, heavily traded ETF, you see that flows are actually directly related to the performance. So it seems that when market is doing well, people start to put money in, and when market is doing poorly, people take money out. And this is consistent with perhaps a shorter term tactical trader who is trying to time the market or perhaps hedge. So it does seem that, at least looking at flows very briefly, the clientele, the type of traders that are present in these markets are a little bit different. So what are we doing in this paper? Well, we have two contributions. The first is a model. We are building a model where ETFs compete and they build endogenous liquidity clienteles, and the ETFs can essentially segment the market and capture rents, have some market power. And second, beyond the anecdotal evidence that we just showed for the free ETFs, we bring more systematic evidence that ETFs indeed charge a liquidity premium, an MER premium. That ETFs that are more liquid are actually able to charge a higher fee. And this is interesting because liquidity is an endogenous characteristic of the ETF, right? So it's not simply a quality decision variable that the ETF can set on, but liquidity is formed in the market from interactions between traders. In terms of frictions in the model, we have three channels. First, we're going to have network effects. So investors want to be in ETFs that are widely traded because that's where they're going to find counterparties, but it's very difficult for them to coordinate on which ETF to go to because there are many investors. There is horizon heterogeneity. So you're going to have long-term investors and short-term investors. And finally, you're going to have staggered entry, which is going to generate the first mover advantage for the first ETF on the market. And we're going to model this through some switching costs. We relate to different stands of literature. I think perhaps the most interesting is the product differentiation literature in the mutual fund industry. There is a QJ paper by Putniņš and Syverson that show that search costs, for example, or product differentiation allow managed fund to extract rents. In this paper, we have no search friction. ETFs are homogeneous product, and the differentiation actually comes out endogenous through liquidity network effects. We relate to the liquidity begets liquidity literature on fragmentation, and callback here is for the classical Pagano paper in '89. What's super different about our setup is that we actually have the heterogeneity in investor horizon, which allows not only one massive natural monopoly ETF, but multiple ETFs to sustain themselves on the market at the same time. And finally, we relate to a growing literature on the role of ETFs in financial markets. My co-author Tālis has a paper with Izli, Michalchuk, and O'Hara, Alexchenko and Vyacheslav Voss, Diane Scheib, and David Franzoni, and I think many others. So what are the takeaways? So first of all, we find that liquid ETFs charge higher fees. 0.47 basis points in fees for every basis points lower realized spread. Heavily traded ETFs charge higher fees too. If you double the turnover in ETF, then the MER increases by 1.12 basis points. And the reason is that investors actually have to trade off liquidity and management fees. If you're a short horizon investor, you're going to value liquidity more than low fees because you're going in and out of the fund, so you're going to incur the spread more often. And your holding period being short, you're actually not going to pay a large amount in fees. If you're a long horizon investor, then you're going to be on the other side of the trade-off. You're going to value the low fees much more than you do liquidity because you're not transacting a lot. You're just going in the position and then out perhaps at some faraway point in the future. But throughout the period that you're holding the asset, you will actually have to pay the fee. So that's costly for you. So in equilibrium, what we showed is the ETFs will specialize in catering to these different clienteles. And because they can separate, they can earn economic rents. In the most likely equilibrium, to put it like this, the first mover ETF will serve the frequent traders. It will charge a high fee and it will be very liquid. And this corresponds to the example of the SPDR ETF on the S&P 500. The second mover ETF will cater to the long-term investor. It will be cheap and relatively liquid because it's not addressed to people that trade a lot. And this corresponds to BlackRock and Vanguard's ETFs in the S&P 500. The number of ETFs in the industry depends on the interest in the given index. So if the asset under management of the index as a whole is very low, then the first mover ETF can actually deter the entry of competitors. And from a normative point of view, if you have this market segmentation, you have this rent extraction, you will have network inefficiencies. You're splitting the network, you're splitting the liquidity pools, and that will actually impact welfare negatively. So next I'm going to go to the model, but before that, we're going to have a little Q&A break.
All right, I'm in the happy position that I have gardeners blowing leaves right up behind me, so I apologize for the noise to everybody. There's a few questions in the Q&A, and so the way I read them is they go all in a similar manner. So Amy Edwards asked about the fund flows. What do they tell you? Cameron asked questions about the structural differences between these. And then Chaoying Wang asked questions about the redemption and creation process. And so let me take a step back and say this, more generally. So ETFs are slightly, I'm not like mutual funds, right? So it's not like you have a mutual fund producer that then sells them directly. In ETFs, you have various different players involved. You have some form of, participant who creates these units and who works basically as a market maker. So what I'm trying to say with this is maybe you can start by saying a little bit about the liquidity of ETFs. How does it actually work? Because the liquidity of an ETF is more than just the bid-ask spread or the depth in markets, because there's also the possibility of creation and redemption in real time of these units. So maybe can you speak to that first, and then we can talk about the features about what do the fund flows actually tell us.
All right, thanks, Andres. So actually, the way we model it and the way liquidity works is that you have this primary secondary market for the ETFs. The secondary market is essentially where buyers or sellers of the ETF itself are transacting. The primary market is where an authorized participant will actually be able to create or to destroy or to redeem units in the ETF. So the way we think about liquidity here, it relates to both. The harder it is to actually unload inventory in the underlying securities market, the less liquid the ETF will be. The more interest you have on the secondary market, the more buyers and sellers of the ETF itself, the more liquid the ETF will be. So in the model, and we'll see that in a second, creation redemption is a last resort of the authorized participant. The authorized participant will try to match natural buyers and sellers of the ETF in the secondary market. If she cannot do this in a reasonable amount of time, the authorized participant will have to go to the underlying market and incur some price impact. Empirically, we control for all these subtle differences between ETFs, for example, the creation redemption fee, for the tax treatment, for whether they pay dividends, they reinvest dividends on a daily basis or they reinvest them on quarterly. So we are aware that there can be subtle differences between ETFs, but we don't think these will centrally affect the story, at least to the point where it can generate a twofold difference in fees and a 16 times fold difference in volumes and liquidity. And going back.
So maybe
yeah.
So maybe you can ask a question and so go back to Amy's question, right? So she talks about she wants to know something about the fund flows that you have. So you've touched upon that in your answer slightly. But maybe you can speak a little bit more about what that actually tells us. Does that tell us something about the fund, the liquidity of it? So both in terms of, what happens in markets, but also in terms of your model, which we haven't seen yet, I understand, but maybe you can still comment on it.
So the way we look at this picture here, we're thinking that different trader types with different horizons. So we think of this picture as telling us something about the horizon of the investor, about their sensitivity to short-term market movements. So when we look at the iShares and the Vanguard, this is all flat. So it seems that investors in iShares and Vanguard, they don't really condition whether they put money or they take money out of the ETF, they don't really condition it on how the market is doing. So this is sort of the buy and hold type of trader who would have some savings, put it immediately in the market and wait for retirement. Whereas in Spider, this sensitivity seems very high, the sensitivity of flows to market performance. So we think of that as more short-term traders who are trying to time the market and capitalize on gains, and that's when they're going to invest in the market, or they will incur losses and they will pull out. So what we're trying to say with this figure is not necessarily something about liquidity directly, is to say that it seems that these traders in Spider and the competitors behave differently. They have different business model of sorts. That was what we were thinking of. This is like a clientele effect, that the traders are behaving differently with respect to how the market is doing.
Okay, so then there's one last question comes from David Simon. And so he wants to know about whether or not there could be an effect coming from the securities lending and borrowing business. So is that something that could have an effect on the fees that they could charge? And also
that's a very close to my heart question, because I'm doing some work on security lendings too. I don't think. For sure, security lending will get some revenue that will push the fees down, but I'm not aware of any difference between the free ETFs in terms of the access to the security lending market. That's point A. So I'm not sure whether that would explain the differential. And second, this picture in particular is looking at S&P 500 stocks, right, which are actually very easy to lend. So there's not a lot of security lending revenue in S&P 500 stocks. Most of it comes from small caps. Okay,
so maybe we're going to talk about this graph probably at some later point. And and also some of the other data that you have and that you're going to present later. So maybe you're just going to move on to your model, and then we're going to see what happens in the next break.
Sounds good. Thank you, Andreas. All right. So the model is actually, it's relatively simple. We have one risky asset, which is we can think of as an equity index, and this is going to have a stochastic payoff, V normally distributed with mean mu and sigma squared. For simplicity, we're going to normalize the risk-free rate to 0. And we're going to have two ETFs that are going to track this index. And we're going to label them L from leader and F from follower. And the reason is that the leader is actually launching before the follower. So it has a first mover advantage. Each ETF has a marginal cost of managing the asset. That's set at small c. And a fixed entry cost that's gamma. And the ETFs are going to charge the fee FL for the leader, FF for the follower for each unit of assets under management they manage, proportional to the length of time that the investors are actually in the ETF. We have a continuum of risk neutral investors who will choose between funds, and we're going to come back to the investors on the next slide. And we have authorized participants. So authorized participants, as Andreas was mentioning in the questions before, they are making the markets in ETF. So they have an inventory constraint of Q units. Essentially, that means that they can only trade with one investor at a time. And they engage in creation redemption. So they will try to match investors on the ETF market, buyers and sellers of the ETF. But at some point, they will decide, well, I have too much risky inventory, I need to unload it. And this is going to be random with intensity eta. And they will unload the inventory to a market maker, to a dealer on the underlying assets. And these dealers in the underlying asset market, they're going to be very simple and passive. They're going to simply be like a Kyle model, mean variance competitive dealers with risk aversion gamma. So they are going to absorb whatever the authorized participants are not able to match in the secondary ETF market. Now the core of the paper, what makes the paper moving, is the investors. So we're going to have a unit measure of investor indexed by I. So each of them will have a stochastic private value for holding the market for exactly Q units, right? So that's exactly what the authorized participant was allowed to hold. And this private value can be either theta or 0, right? So this is very similar to, for example, how Pagnotta and Philippe One models switching private values over time. So at any point in time, exactly half of the investors would hold the index, because half of the investor would have a positive private value of theta. The ones that have a private value of 0, they see no point in actually paying the fee to hold something that doesn't have a particular value for them. So the assets under management at any point in time are going to be Q, how much an individual unit holds, over 2, because half of them hold the index. And the investor's private value, they switch between 0 and theta with some intensity, lambda I, which is investor specific. So each investor will have an expected holding period of 1 over lambda I, the reciprocal of the trading intensity. So this is where we put in the heterogeneity. So we assume that the switching rates are actually uniformly distributed between some capital lambda minus psi and capital lambda plus psi. So the average switching intensity is capital lambda. So an investor with a low switching rate, closer to lambda minus psi, they will have a longer holder period. So these are going to be the long-term investors in the model. An investor with a high switching rate, closer to lambda plus psi, they are going to have a short-term horizon. So this is the nature of heterogeneity that's going to drive the differentiation. And more of a technical assumption, the investors will know this dispersion. They will know heterogeneity level, but they will not know the actual mean. And this can be relaxed, but it allows us to get more closed form solution. And each investor will actually trade off the management fees and the expected liquidity. And the liquidity will depend essentially on the amount of investors that are in the ETF and on how risk averse the dealer on the underlying is. All investors will start in the leader fund, which is the only one on the market when you begin, but they can all switch to the follower if they want to. They just have to incur a one-time switching cost delta. Right, so just going to the timing of the model, the beginning, T-2, all the investors will be in the leader ETF. And then the follower decides whether to enter or not. And both the leader and the follower, they will choose some management fee. Once they see that, the investor will make they will update their beliefs over who the other investors are, and they will choose in which ETF to trade on. So that's the ETF selection stage. Once investors are in the ETF, trading begins. Investors might get a private value shock, in which case they will trade with the AP, with the authorized participant, and then the authorized participant can either wait for an opposite side investor to arrive, and basically they will net out the trade. Or if it doesn't happen like that, they have to go to the primary market and actually create or redeem the shares by trading with the risk-averse dealer. So that's going to be more costly. From the authorized participant point of view, it's always better to match a buyer and a seller in the secondary market and collect the spread rather than pay the creation redemption costs. So in this game, what an equilibrium will be, it will be a decision for the follower ETF if they want to enter the market or not. There will be the management fee choices at T-1, the investor choice of funds, and then two price schedule. One price schedule posted by the authorized participant on the ETF markets, on the secondary market, and that's going to be a function P of the quantity traded. And the buy and sell price is quoted by the dealer on the underlying market, and that's going to be buy. So the dealer's demand function, it's actually very simple. It's exactly like in Kyle. The dealer's demand is going to be the expected value of the asset new plus a compensation for the inventory. All right, and before we go to solving the model, we will perhaps have a Q&A break about the assumptions and the structure.
Sure. So Marius, there's a question from Pete Kyle. I'm going to read it out. How does the E-mini S&P 500 futures market fit into the picture? So is there more depth than on spiders? Are there higher costs? Is there more volume, more short-term trading? So there is an older literature on the first mover there in terms of in terms of creating the futures and the liquidity thereof. Are you?
Actually, we haven't looked at E-mini, and that's a great point. We think that the liquidity providing mechanism is quite different, right? Because there is no creation redemption. So I think in terms of the incentive for the market makers, these might be somewhat different. But it's definitely something we're looking at. I don't have an answer right now, but this is definitely something to look into.
So then I have another question about your model, since there's no other questions here. So the way I understand it is essentially, it's a closed system, right? So people are invested in a particular fund, a new fund comes along, and then they can switch at a given cost. Now, the way, just anecdotally, the way I buy ETFs is I get a salary, each month, and hopefully, and then I spend some of this money to buy securities. So, what I'm trying to say is that there are fund inflows coming into the general economy from people continuing to make savings, and so people are not invested with a particular ETF. So once you get new fresh money, so to speak, it could potentially go to the one which has just the lower fee. Is that something you consider, or is that something that doesn't fit into your model?
We don't consider this explicitly, like sort of like expanding the universe of investors in some sense. I guess it also depends, right? If you assume that the new entrants are all long-term retail traders that are putting money in, then you're right that the distribution of investor will change. But we're thinking that maybe investors drop and have new inflows that are sort of proportional to the holding horizon, right? So it's not only you who are putting new money in, but also short-term investors will constantly rotate.
All right.
So I'm thinking of this more of a steady state distribution rather than new long-term money is coming into the system and it's crowding out short-term funds or short-term traders.
Yeah, so I don't want to have hog the conversation, but if you have a steady state, then it's a little more difficult, I think, to think of a leader. But let's postpone that part and my own questions about this. And how about you move on and then show us your results?
All right, thank you. All right, so we're looking first at the authorized participant and how do they make the markets, and the key variable here is to look at the counterparty arrival rate. So once the rate at which the authorized participant will have a counterparty on the secondary market, it's essentially the sum of arrival rates of all investors that choose that fund, right? Everybody that's in that fund, times a half, because you're wanting to make a directional trade. So if you had a buy trade and you want to find a seller, then with probability 1/2 across all investors, you might find a seller. So then what's the expected profit for the authorized participant, assuming that they have a price schedule of this form, like A plus B times the quantity? Well, either they find a match, either they find a counterparty, an opposing trade on the ETF market before they have to engage in creation redemption, and that happens with probability lambda k over eta plus lambda k, in which case they are collecting twice the spread. They have the original price that they cashed in for the original buyer, and they turn around on the secondary market and they get 2B times Q. Or in case they couldn't find a counterparty before they have to engage in creation redemption, they're going to keep the original price from the original trader, but then they have to turn around and pay the price impact by trading with the underlying dealer. So that's going to be costly for the authorized participant. So once you solve for the equilibrium ETF price on the secondary market, this is going to have a rather familiar form. It's going to be the expected value of the asset plus compensation for the risk aversion of the dealer on the underlying market, plus this quantifying term, which essentially is the frequency of creation redemption divided by the creation redemption frequency plus the probability of finding a counterparty on the ETF market. So if this lambda is very high, then it means it's very easy to match buyers and sellers on the ETF market without having to go to the underlying stocks, which means, because everybody is risk neutral, that the price will be very close to the expected value of the asset. However, if lambda is very low, if there are not a lot of traders in the ETF market, then you're going to have a much higher price impact. So then if you take this price and try to sort of transform it into a round trip cost for investors, which is essentially going to be equal to twice the difference between the price and the expected value, twice because you have to first buy and then sell, or vice versa, you find that essentially the round trip cost is negatively related to the aggregate liquidity in the ETF, so the probability of finding a counterparty, and positively related to creation redemption intensity, so how much the authorized participant wants to unload the inventory on the underlying market, and of course to the characteristics of the dealers on the underlying market, the risk aversion and the volatility of the asset. All right? So then the expected profit of the investor is going to consist of two parts. Essentially the holding profit is going to be the holding period, the expected holding period, 1 over lambda, times the difference between the investor's private value and the fee that they have to pay, everything scaled with the quantity they hold, minus this round trip cost that we discussed in the beginning. All right. So the more investors join the ETF, the lower the trading cost. But you're going to value this much more if you have a longer period. If you have a longer horizon, if your lambda is very low, then this term here is going to dominate and you're not going to care that much about the liquidity. But you still have a coordination problem, right? Regardless of your horizon, you want to be where the other investors are because that's going to minimize your round trip costs. So we're gonna look at the marginal investor. The marginal investor is going to be a threshold in horizon, lambda bar, and essentially all investors that have a higher arrival intensity, so basically a shorter horizon, are going to go for the most liquid ETF. I'm not sure yet whether this is going to be the leader or the follower. Let's just call it L+. And the investors with a lower intensity, with a longer horizon, are going to care more about the fees, and they're going to go for the least liquid ETF, which we're going to call it L-. So essentially, we can solve for the ETF turnover by essentially integrating from the marginal investor to the end and find expressions for the turnover that depend on the horizon of the marginal investor and the level of heterogeneity. And then we impose the condition that the marginal investor has to be indifferent between choosing the two ETFs. And we're going to end up in a situation where you have multiple equilibria. Either the leader or the follower can be the liquid expensive ETF. We're going to have two different expressions in terms of fee for the marginal trader. That's going to depend on the fee differential and on the switching cost and basically the risk and risk aversion on of the index, the risk aversion of the dealers. Now, an interesting result in the paper is once we solve for fees in both equilibria, the marginal investor, it's going to end up to be the same. So both these equilibria yield the same predictions on market shares and on equilibrium fees. They're just reversed. Now we think that the liquid leader equilibrium is the more likely one, is the more natural one, because it fits the intuition. Like the industry leader will build some reputation, and that's going to coordinate investors' beliefs on what the focal fund should be. Investors might have seen that fund being liquid in the past, so that can serve as an anchor to expect liquidity in the future. And from a more model-oriented perspective, we actually find out there is no liquid follower equilibrium if the switching costs are high enough. So you only have the liquid follower equilibrium if delta, if the switching cost is lower than some threshold. And finally, the liquid leader equilibrium will yield higher welfare. And the reason is because you're going to end up with the same market shares. In the liquid leader equilibrium, you're actually forcing fewer people to switch to the follower, which is going to be better in terms of welfare, because both equilibria will have the same networks in some sense. So going back one step to T-1, we're going to solve for the equilibrium fees and the equilibrium profits of the ETFs. So the market shares for the leader, let's focus on the liquid leader equilibrium, is going to be every trader from the marginal trader to the trader with the arrival rate lambda plus psi, scaled by the 1/2 psi, which is the mass of traders. And for the follower is going to be everyone with a low enough arrival rate, so from lambda minus psi to the marginal trader. And then the investors are going to set the fees jointly to maximize the profits, right? The quantity, the assets under management per individual investor times the market share that they capture times their profit margin minus the fixed cost. So what do we get in terms of results? First, we get that ETF entry only occurs if you have enough investor horizon heterogeneity, right? So we plot the fixed call threshold below which there's going to be entry against investor heterogeneity, and you see that there is more entry in this industry if psi is larger, because a larger heterogeneity allows for more rent space, rent extraction space, allows ETFs to charge higher fees and capture this heterogeneity and get enough profits to cover the fixed costs. So you're more likely going to have entry. And also the higher the assets under management, this is perhaps not surprising, the higher profits the funds can make, the more likely you are to have entry as well. We find that both ETFs will charge equilibrium fees that are going to be above the marginal ETF cost, while the leader is going to charge the highest fee, the follower is going to charge a lower fee, but still above cost. And again, both fees are increasing in the amount of heterogeneity. Heterogeneity in the investor horizon allows the ETFs to split the market and lock in their clienteles much better and extract rents. The market shares, in terms of how many investors there are, the leader fund will capture a market share that's higher than half. The follower is going to take a second place in the industry, is going to capture something that's lower than half. In the end, their market shares are going to converge as heterogeneity increases, but that doesn't really mean much. The market shares in terms of number of traders, but because the leader fund captures the short-term trades, they're actually going to have a much higher turnover. If you look at turnovers, the leader fund turnover is going to be much higher than the follower fund turnover, because the leader fund has a higher market share, but also because every individual trader going with the leader is a short-term investor that trades a lot. But what you see is that essentially the leader still has a lower turnover than the turnover to be if you have a single fund, and that's because there is a network inefficiency. Because the follower can capture away some of the traders, and you don't find essentially enough counterparties for the leader. You're chipping away some of the liquidity. So that brings us to the next point for the model. It's trying to build a sort of a welfare measure. So our benchmark in this economy, our first test would be a competitive ETF. So there is no friction, a single competitive ETF. Which is unique, so you don't have this inefficiency of splitting the network into two. So therefore, the turnover is going to aggregate across the entire universe of investor, right? So from lambda minus psi to lambda plus psi. Now, the aggregate utility across all investors in this benchmark economy and the funds, the fees will wash out. It's essentially going to be the difference between the private value and the cost. The private value for the investor and the cost for the ETF, minus the compensation that you still need to pay to the dealer, times, of course, the asset under management minus the fixed cost. So there are going to be a couple of sources for welfare loss. There's obviously going to be the fact that you have two ETFs rather than one, so you're going to incur the fixed cost twice. You're going to have the switching costs, but the most important is this network inefficiency, the fact that having two ETFs is going to segment liquidity. So you're going to have two liquidity pools that don't readily communicate with each other. So that means you have to engage in creation redemption much more often. So if you plot this welfare loss against the investor heterogeneity, you see that the higher heterogeneity you have, the lower the welfare, the higher the welfare loss. And this is not necessarily due to the fees themselves, because the fees wash out, but it's because you're splitting the market into these liquidity pools. Now, if you have a higher switching cost, that's going to yield a higher welfare loss. You're moving from the blue line to the red line. And if you have a more intense creation redemption, if the authorized participant is not waiting long enough to match buyers and sellers in the secondary market, then you're again going to have a higher welfare loss. Okay, so this model yields a couple of predictions. First, that ETFs with the higher fees, they will have a higher market share and they will attract short-term investors. There's going to be a correlation between the two. ETFs with a higher fee is more likely to have higher turnover and higher liquidity. And you're only going to have multiple ETFs all trading on the same index if investor heterogeneity is large enough and if the assets under management are large enough. Okay, so next we're going to go to the empirical evidence. I'm going to show you some data, but before that, I could take any questions on the model, for example.
Well, we are at 46 already, 47. Oh. Marius, I'm not sure how much time you want to spend on the empirical evidence. Maybe it's a better idea if we go and ask all of the questions, and there's quite a number of those in the Q&A now, once you're done with your empirical evidence, so that you can get through your materials for now. Okay.
Okay, I'll try to go very quickly for the empirical evidence. We have daily data from ETF Global, excluding exchange trading notes and leverage or inverse ETFs. We have 1,035 ETFs traded in the US in 2017, out of which 60 ETFs track 24 indices. So these are like the ETFs that compete over the same index. It's a small proportion of the 1,035, but it's economically the most meaningful. It accounts for 47% of the volume and 36% of assets under management. I'm going to skip the summary stats. I'm going to show you some figures. So if we take the excess MER, like the deemed management expense ratio against the spread, we can see that there is a negative relationship. Like the most liquid ETFs are going to charge the highest MER. The ETFs with the highest turnover are going to have the highest MER, and the ETFs with the highest volume are going to have the highest MER. And in this figure, the big names here are the ones that they launched first, the blue circles. And you can see the blue circles are dominating. They actually capture most of the market. In terms of formal regression, we are zooming in on these 60 ETFs tracking the 24 indices, and we're doing some cross-sectional regression. We're regressing MER on spread, turnover, and some controls. What we find is that basically 1 basis point higher MER is correlated with 0.47 lower basis points. We find that doubling the turnover leads to a 0.39 higher MER, and that doubling the volume leads to 1.12 higher MER. We also do a probit model in which we take the probability that one index is actually supporting multiple ETFs that can thrive on the same index, and we want to see if higher assets under management on a given index, it's actually correlated with ETF entry, and you find that that indeed is the case. Higher AUM leads to multiple ETFs. If an index is issued by a top 3 issuer like Vanguard, BlackRock, or State Street, that's more likely to attract competition. If you're tracking a major index like an MSCI, S&P, or Russell, then you also are more likely to have more competition. So I can come back to this to the empirical results if there are questions, or I can come back to them afterwards. Perhaps if I
well, thank you, Marius.
Yeah, thank you.
Sorry, I'm sorry, I didn't want to cut you off. Are you okay?
No,
are you done?
Yeah.
Okay.
That's good.
All right, excellent. So we have now enabled the raise hand function. Just very briefly, because I noticed that the number of attendees is now significantly larger than at the beginning when I started talking. Just very briefly, the submissions for the fall session are due today at midnight Pacific time. So if you haven't done it yet and you want to submit, please do. And so now there's a number of questions in the Q&A. Because we have the raise hand function enabled, maybe the people who submitted the Q&A, like Vikas, want to ask their question live.
Sure.
I'm just waiting for somebody to raise their hand. If not, I'm going to ask the question. Okay, let's go. Let's start with Hans. You have to unmute yourself, Hans. There you go.
Okay, can you hear me?
Yeah.
Yeah, okay, good.
Hello.
Hi, Marius. Interesting paper. So my question was more whether the, let's say, the ETF providers would potentially have incentives to become a multi-product firm by basically offering, let's say, the two types of ETFs. So here you are basically assuming, that you can only offer one, but they could also somehow deter entry by offering multi or different types of ETFs.
Okay, so you're basically saying that one firm like Vanguard would have one expensive and one cheap ETF in the same.
Exactly. Not sure whether this happens or not. Yeah.
I'm not sure this happens because I think it's more of a marketing type of friction, right? The Vanguard wants to know this is my S&P 500 ETF. Like it would be, I think, hard to justify having two S&P tracking the same product because the differentiation here is fully endogenous. So it's not like they can Vanguard can come and say, hey, I have two ETFs tracking the S&P, one cheap, one expensive, and now you sort yourselves into this. I'm not sure how that will work because there's no other, and I think that's part of the attraction of the paper. There is no other exogenous differentiation variable in the model between the two ETFs. I see your point, and I think in principle they could do it. In theory, you can model it like they could do it. They could try to offer this whole menu of ETFs, but I'm not sure how exactly they would differentiate the menu in their own for their own internal clientele.
Okay, thank you.
Yeah, thank you.
So let's maybe then. Oh, Vikas is raised his hand. Very good. Vikas, you need to unmute yourself.
Yeah. Hi. No, very interesting paper. I learned a lot. I was just curious. That when there is greater turnover in the secondary market for the ETF, it should also impose significant liquidity transformation costs on the AP, especially when the basket of securities for the ETF are going to be illiquid. So in your model, I didn't quite see a role for the liquidity transformation. I was just wondering whether there is, what do you think about that?
Right. Yeah, we don't have a time, like, I think from what you're saying, if I interpret your question correctly, it's more of a time series question. Like in times when the dealer's inventory is saturated, it's going to be harder to move inventory, and that's going to increase the cost. What we're trying to focus on, I think, is mostly a cross-sectional prediction. So we're not looking at a time series variation in turnover. We're taking like yearly averages and saying if this particular ETF has a higher turnover, what does it mean? It will mean that it aggregates. It will aggregate more investors. It will aggregate a higher mass of investors, potentially shorter-term investors. So we don't have this time variation component, which I think it's very relevant. I think that's sort of where your question is trying to go, if I'm right. We're really looking at cross-sectional differences.
The inventory part is the time series dimension is one of it. I had not thought about that, but I was wondering if you were to do your study for different types of asset classes, even then you might see that if the underlying securities are very illiquid, you might find results to be somewhat more stark when you actually look at the illiquid securities. So suppose you take S&P 500, you may not see that much going on because the underlying securities are going to be relatively liquid. But suppose if you were to do the same thing for corporate bond ETFs, for example, then it would probably play
Okay, yeah. Now we're trying to talk within the same index effects. So what we're focusing on is competition between ETFs on the same index. So how do SPDR and IVV and VO compete on trading S&P 500 securities? We're not looking at we're trying not to compare two very different indices or two very different asset classes.
Just to clarify, I don't want to take too much time, but I think if you did the same analysis within corporate bond ETFs, you might find the wedge to be much more. That's what I was saying. I was not saying comparing equity with bond ETFs, just to clarify. But go on here. Sorry, I don't want to take more time.
Thank you, Vikas. How about Cameron? You're next. Cameron, go ahead. Okay. Cameron, you're not going to talk? Okay, so something must be wrong with Cameron's text. So maybe I can just ask one of the questions from the Q&A. So Evangelos asked, empirical question regarding the liquidity of SPDR ETFs relative to Vanguard. So what actually empirically would be the difference between these?
Yeah, I don't know at the top of my head because we just have averages here. But we know the difference in turnovers. I think for the S&P and Vanguard, I don't think that the liquidity difference is very different. Maybe it's like 1 or 2 basis points because they're all tracking the S&P. But I think for this particular index, what's really striking is the difference in turnovers. So I think the difference there is basically just 1 or 2 basis points, but I would need to confirm that.
So Michael Pagano has a question. Maybe Michael, do you want to ask it live and raise your hand? Yep, there he is. Okay, off you go.
Okay, thank you. Can you hear me?
Yep. Yeah.
Okay, great. Thank you. Thank you for taking the question. And thanks for a great presentation there. It's really an interesting paper. My question relates to hedging demand. So one thing that's kind of anecdotally been said is that the SPDRs are used a lot of times by dealers to hedge their underlying stock portfolio because it is liquid and it's kind of a proxy for the marketplace. And your model is set up more obviously from a private valuation point of view. So the question really is, is there room in your model to think about hedging demand beyond just private valuations? Thank you.
Yeah, no, that's a very good point. I think that's going to go in the same direction. Like, I think you can also think of the private valuation as a hedging demand for a position that's somehow outside the model, or you can model this explicitly, but I think this sort of anecdotal evidence that you're mentioning goes exactly in the direction we're trying to make, because hedging demand, it will be a short term. It will need to be updated on a very high frequency basis, as opposed to a buy and hold type of strategy. So I think modeling this explicitly will add to the model, will add in the direction of our predictions. But that's a very good point. We should use that anecdotal evidence in the paper. Thank you.
Very good. Thank you.
Okay. Okay, thank you, Michael. So the official part is now over. Marius has agreed to stick around for a few more minutes for additional questions, but I want to thank everybody to be part of this series. I want to thank everybody who has come to the seminar series since we started it a few months ago. We're going to start on July 7th with the Emerging Scholars Month for 6 presentations for our younger colleagues. And then we're going to take a quick break and start back again in the fall. One more time, the submission deadline is tonight for the fall presentations. And so thank you, and thank you, Marius, for a great presentation.
Thank you.
So, okay, now Cameron tells me he has fixed his microphone, so maybe you can ask a question in the now unofficial portion.
Okay, is it working?
Yeah.
Okay, cool. I can see my weird face, so I know that everyone's hearing me. Okay. So have you thought about endogenizing this like authorized participant like laziness term, right? This ADA parameter, because I can imagine that the authorized participant has kind of, if they know that they're dealing in one of the ETFs that it has this like clientele effect where everyone's drawn to it, like maybe they want to tilt towards trading more frequently or less frequently for, kind of the follower fund. Do you know if that would like kind of change your model? Do you have like thoughts on that? Yeah.
Yeah, I mean, okay. I see your point. The way we think about this ETA, about this sort of exogenous shock that the AP will basically have to go on the underlying market, we think of it as standing for some sort of risk aversion and or like sort of a deadline or the close of the day, right? Some sort of a margining constraint. Like you're hitting the margin, you have to post collateral rather than paying collateral. You're just going to go to offload your inventory. Now, if you think of this ETA as individual AP risk aversion, and you say, well, this is maybe different between different authorized participants, you're right. It's likely that you're going to get in equilibrium where they self-select. Let's say the AP with a lower ETA that's more willing to take inventories, he would go to the cheaper ETF, the one where inventories are likely to accumulate because there are not a lot of short-term traders. The very risk-averse ETF would go to the ETF with the less risk-averse AP would go to the ETF where there's a lot of trading because they're unlikely to end up with a lot of remaining inventory at the end of the day. But if you think as this ETA as some sort of like institutional constraint, like the central counterparty is asking for collateral at the end of the day, I would think that's sort of the same for all APs, and it's in some sense exogenous.
Okay, so if I can ask a follow-up question then.
Sure.
So if that's the case, right, I can get how this ADA term would be exogenous, right? All APs would share it. So I would actually think then that there's actually some meaningful endogeneity in the dealers component, right? Because let's say you have two APs, one AP deals more heavily in an ETF that is more active, so the dealer maybe expects to have differential transaction costs when it trades with that ETF. Maybe there's more like informed flow or something. I know that's more complicated than I think your model needs to be.
Okay, sorry.
But I think there's a meaningful component to the dealer's transaction costs that shows up through this selection mechanism at the top level in the ETF.
Okay, so
I don't know. That's not really a question, but
yeah, no, I see what you mean, and indeed, our dealers are very reduced form, right? Because they stay somewhere on the underlying market and they just absorb quantities, and it's in the background of this model is that every time the AP is trying to unload a piece of inventory, it will essentially meet a new dealer, right? because there's no like time dependence in the dealer's inventories in some sense. So we're thinking of this as a mass of competitive dealers. One of them is absorbing the inventory for the AP, and we will have this price impact, and then it sort of goes away until it can sort of mean reverted, and then the next trade will be with a different dealer.
Okay, thanks.
Yeah. Thanks. Okay.
Mao, how about you go?
Oh, okay, great. So Marcus, can you hear me?
Yeah, hi, Mao.
Okay. I have a clarifying question. So in the graphs, you see like the fund flow of 3 ETFs. Did you normalize that based on the size of the fund? So that's the part I get a little bit confused. Yeah, this one is like because SPY is bigger, so you see larger volatility of the flows. But should you normalize that based on the size of the fund, or I missed something? Because the flow is based on billions of dollars, right? And the spider is bigger, so you see larger volatility. But it may be because of the spider is bigger than the other two.
Yeah, you're right. You're right. These are not normalized. So this is basically, we just took it from Morningstar Direct. I just thought it's a cute picture to include, but you're absolutely right. I don't think this is normalized.
Yeah. This
so
is
not that I want to answer your question, Mao, but it seems like the direct flows are more important than the relative flows to fund size, right? Because the whole point about it is that he says if there's a lot of flows that you have in and out, that gives you a lot of that gives you a lot of liquidity that you can then, in terms of in terms of the creation and redemption. So for Marius' model, I think the levels are more important than the relative amount.
Okay,
right?
okay, yeah,
Marius?
makes sense.
Yeah, that's true.
Yeah. The second is Khomyn. Actually, it follows the Hans point. I think Hans make a great point. It's like a multi-product competition. I think in exchange space, stock exchanges do create multiple platforms because there's a benefit. So in your ETF space, maybe you can pin down. It's like under some condition, like an issuer, let's say Vanguard, have no incentive under some condition with some frictions, has no incentive to create a second ETF to preempt their competitors. I think that would be really, really interesting, because then there's some condition. It's like you say they have no incentive because of some friction. They have no incentive to create a second fund, even if they invite some kind of competitor from outside. I think that would be interesting. Then that would be a prediction, right? So the prediction is like Vanguard have no incentive to create a second fund.
Yeah,
no, I don't know.
I fully agree with you, with Hans. Like this would be a really neat implication. Where I'm a bit worried, it's about sort of how this would be implemented in practice, because you're right, in the exchange space. In the exchange space, this happens a lot, but in the exchange space, there's a lot of space to play with characteristics, right? With the tick size, with the fees. So you can say, well, I'm offering products that cater to different people, that have slightly different technical features, and that's why they're different. But I'm not sure how Vanguard would offer two exactly identical products at different prices, because they would have to signal.
In exchange space, my paper basically shows like you manipulate make and take fees to segment the clientele. So in this one, I think your intuition is like you manage. There's management fee and there's a liquidity, right? I think you have already built a platform to study that question. So it's something similar. But I think without any friction, probably they always have incentive to create multiple, multiple like funds. But in your model, your model have some kind of, they need to deal with the dealer, and there's also some cost to establish of ETF, right? Am I right? So that might be larger enough to prevent, even if there's a small benefit because in my model, I know the result is like the marginal benefit to create another exchange is so small. So because you create a competitor with yourself. So if you operator create two exchanges, these two exchanges actually compete with each other. So their combined profit, the increase in the combined profit is not very large. So that if you add a little bit of friction, maybe they only create one. I don't know. Maybe in your model that can be true. It's like they finally have no incentive to create like two ETFs.
Okay, that's that's
because they compete with each other, right? Yeah, because the platform actually compete with each other. Although you sum their profit, there might not be a large increase, I guess, because of the network externality in your model. They might need to go to dealers more often. I mean,
yeah.
Would like to give the word also to Andre now, if that's possible at all, unless you want to make another response, Marius.
No, that's a good point, Mal. That's a good point. We'll definitely look into this. These issuers offering the menu of ETFs.
Yeah, this is my 2 cents. Maybe it doesn't work in your model. It's just some intuition.
That's interesting.
Just
Thanks so much. Thank you.
Yeah,
Andre, you go ahead.
Hi, Marius. I first of all wanted to congratulate you on your recent wedding. I don't know if Andreas mentioned this at the beginning. I teach for the first half hour of this now, so I don't know. But anyway, congratulations.
Thank you.
Also, not sure if you've mentioned this, but I've always been curious why we have multiple ETFs for some indices, but not others. And the one that comes to mind every time I sort of think about it is the NASDAQ 100. In my understanding, we only have one QQQ. There are some equal weighted derivatives of that you guys mentioned in your empirical section, I think. But does it fit in your model that some indices never developed alternative ETFs?
We do have an endogenous entry decision there. So what we show is that you have multiple ETFs tracking the same index when there is enough interest, when there is enough asset under management, and also when you have enough heterogeneity in investor horizons. So if all the interest in let's say NASDAQ 100 comes from short-term investors, you might not be able to extract enough profit to cover the fixed cost of entry. So the one condition to have multiple ETFs is that you need to have a diverse enough clientele of investors so that you can sustain multiple ETFs in equilibrium.
Okay, so if we assume that multiple horizons investors exist for many major indices, I'd be very curious from the empirical side to know how many single ETF indices are out there, because I'm curious to know if this is just an aberration and if QQQ is just one-off, or if this is something that actually happens quite frequently.
It happens really frequently. Like the multiple ETF indices, I think is the exception. Like just counting ETFs, we have 1,000 ETFs in our sample, and out of this 1,000, only 60 of them are competing against others. So it's basically 94% of ETFs are focused on a single index. And basically what's the ETFs that compete are on the usual suspects. So they're on the MSCI indices, on the S&P, on Russell. If some big firm like a Vanguard or BlackRock ETF in a given space, then there's going to be more competition. So clearly, I think the ETF, like in terms of number of ETFs, the ETF competition is the aberration. But these 60 ETFs actually have basically a half of the market.
Okay, thank you.
Okay.
All right, we are now at noon, which is the time at which we commonly close the discussion. I'm not seeing anybody else raising their hands. But before I thank Marius, I want to just point out the one thing, which is that the first ETF traded where? Canada. Toronto, exactly. So in case anybody forgets that, Canada was first. Again. And you know, congratulations on also the basketball rules. But anyways, although I think that's contested. Anyways, so I think I'm going to close it here. And I want to thank Marius for your presentation and for being part of this. And I want to thank everybody for sticking around for so long. And I'll hope to see you guys in person soon. Thank you.
Thanks so much. Thank you for your comments. See you soon.
Okay. Bye-bye, everyone.
Bye-bye.